Welcome to the Explainer. We all know currency makes the world go round, right? But today, we're popping the hood. We're going to look straight at the actual plumbing of global money movement and the hidden mechanics of Forex trading.
Think about a totally everyday cross-border transaction. A guy in Nigeria buys a brand new smartphone that was manufactured in China. Well, the Chinese manufacturer doesn't exactly pay its factory workers in naira, right? So how is that gap bridged behind the scenes at such a massive scale? Or picture a huge U.S. distributor bringing in tons of Brazilian coffee. The local American roaster operates in U.S. dollars, but that Brazilian farming co-op, they absolutely need reals. It's not just a simple swap. It's about the sheer, dizzying speed of these transactions happening literally millions of times a single day.
And then throw remittances into the mix. Say, someone working in the UK sending money back home to their family in Nigeria. On their own, these flows might just seem like drops in the bucket. But zoom out, collectively, they are the very foundation, the microdrivers of the massive institutional foreign exchange market.
So, here's our roadmap for this explainer. We're covering everyday global transactions, the business of money, how money actually moves, the mighty US dollar, and finally, why this matters to traders.
All right, let's dive right into Section 1, Everyday Global Transactions.
You know what's really fascinating? It's how completely ordinary these core actions are. Sure, we hear about sovereign wealth and massive corporate trade, but consumer-driven, cross-border volume is just huge. Tourists spending cash on vacation, students paying international tuition, expats sending money home, they all create this constant, non-stop river of capital moving around the world. Think about it. Individually, exchanging some naira for British pounds at a kiosk in Heathrow, kinda insignificant. But aggregate the millions of tourists traveling every single day and boom, you've got a massive, continuous retail demand shock hitting the Forex market at any given second.
Take global remittances, for example. A Nigerian worker living in Canada earns their paycheck in Canadian dollars. But to support their family back home, those funds have to flow straight through the Forex market to instantly become naira. Remittances alone pump hundreds of billions of dollars of liquidity into emerging market currencies every single year. Hundreds of billions.
Moving up a level from the retail side, we hit Section 2, the business of money. So when a business owner in Nigeria orders a shipping container full of laptops from Shenzhen, they can't exactly just wire over a pile of naira. It doesn't work that way. They have to tap into the Forex market to get their hands on Chinese yuan, or let's be real, more likely US dollars, just to settle that invoice. That basic corporate necessity dynamically feeds right into institutional Forex volume.
And then, of course, you've got the heavy hitters, the investment side. Say an American company is physically building a brand new factory out in Kenya. That's what we call foreign direct investment, or FDI. At the exact same time, you might have a European fund manager buying up digital shares in a Japanese tech firm. That's portfolio investment. What do they have in common? Both require local currency conversion, which funnels massive blocks of capital right through the FX ecosystem.
So we get the volume now, but let's check out the actual infrastructure in Section 3, how money actually moves.
Look, when billions of dollars cross the globe, it's not some Hollywood movie with physical cash traveling in locked metal suitcases, right? It's just digital ledgers updating. Banks use what are called Nostro and Vostro accounts, basically just correspondent banking accounts, across global financial networks like SWIFT, to settle these massive transactions practically in the blink of an eye. The currencies are swapped out by liquidity providers, which is exactly what allows global commerce to flow without grinding to a halt.
Which brings us to Section 4, the absolute anchor of this entire system, the mighty US dollar. There is a very specific structural reason why the dollar absolutely dominates. Beyond just being the world's primary reserve currency, global commodities, most notably oil, through the petrodollar system, are literally priced in USD. Because of that, foreign nations and central banks are basically forced to stockpile massive amounts of US dollars just to keep the lights on and facilitate their baseline imports.
At the end of the day, it all comes down to capital flows. When foreign businesses and central banks are forced to load up on US dollars for trade, they gobble up the available supply, which naturally drives the dollar's strength way up against other pairs. On the flip side, if you've got intense selling pressure on something like the euro, more people dumping it, that will inevitably drive its relative value right down. And that brings us to our final part, Section 5, why this matters to traders. It is so easy to just get completely lost in technical analysis, staring at moving averages and candlestick patterns all day.
But you really have to remember, every single tick, every pip on that chart, it represents real global human activity. You aren't just looking at math, you are watching the real-time heartbeat of global trade.
If you want to trade effectively, you've got to look at the catalysts behind those flows. We're talking about the big stuff: GDP data drops, central banks making hawkish or dovish pivots, major realignments in international trade deals, and overall macroeconomic sentiment. Those are the real drivers. Those are what dictate capital allocation and literally steer the institutional rivers of money.
So let's quickly recap. Countries trade, people travel, and massive institutions deploy capital. That simple, totally unavoidable need for cross-border liquidity, that is exactly what creates this massive, dynamic Forex ecosystem that we interact with every single day.
We've mapped out the flows today, but honestly, that leaves us with a pretty major question. Who are the Tier 1 liquidity providers that are actually making these markets? And really, how much power do they honestly have over the exact prices you see ticking on your terminal? Well, we'll uncover those major power players in our next explainer. Until then, keep learning, and thanks so much for hanging out with me on The Explainer.